about balance sheet recession. You can see how quickly that recession was over. We're still in more of a prolonged recession. I'm not giving it quite out of the woods yet. But what we can see is, in terms of capacity, you can't have an imminent inflation threat unless the economy is operating at full capacity, because there's nothing to push wage prices up. Right? There's nothing to push prices of goods up until we move into and are at full productive capacity. If you look back, the traditional or the longer term capacity utilization in the US is around 80%. We dropped down to 65% in this past recession. That's a significant hit to an economy. So that's another factor we're following. It is improving, by the way, but we're still a long way from the long-term normal. So the inflation issue, Canada is in pretty good shape today. The Bank of Canada is managing the economy quite well in the face of inflationary pressures. The thing I'd like to point out here is that the inflation target for the Bank of Canada is 2%. That doesn't mean it wants it lower. It means it wants inflation at 2%. Because in order to induce consumers to consume, you need inflation. Inflation is a necessary element of economic growth. So to have 0% inflation gives us deflation, or moves us into deflation, which in a very simplistic way says consumers have no incentive to buy now because they could wait for a year and buy in a year. So that's why when you hear central banks talking about inflation targets, they're going to target some inflationary aspect to the economy. So the Bank of Canada will follow this, but is also, as we all know, very tied to the US and what goes on in the US. This is what I like to call my economics geek slide, because this is about money supply. Right? And if you were in the business 20 years ago, or if you read the business papers 20 years ago, you couldn't wake up in the morning without somebody with a headline blaring, "Where was M1?" And that's basic money supply. Because that's what we ran our thought process through, was how much money supply is in there. Remember what was happening 20 years ago was inflation. We had a heavily inflationary environment. So money supply becomes important, or even more important than it is today. What we're following, and you can see this probably better at your tables, but the arrow points there to M3. That's a more broadly described money supply. It means not just what can the central bankers put into the money supply by virtue of currency and increasing bank deposits, but what does this mean in terms of a broader sense of what's being loaned to different entities? In other words, a broader definition, a larger definition of money supply. What we see here is that short-term, or that narrower definition, is rising. Central banks are putting money into the system to give it liquidity so it's got something to move with. What's not happening is it's not getting into the rest of the economy. And that's what, when we look at M3, that broader definition is actually dropping year over year. So money, even though the central bankers are trying to get it into the system, is not percolating through. It's not multiplying through the system. So again, sustainable recovery requires a heavy dose of liquidity throughout the system. And right now, we're not seeing that. And by the way, that's why $1 trillion went towards saving Greece. We'll talk about that later. I'll spend just very quickly on the factors about net debt, and this is global net debt, as a component of gross domestic product, or GDP. The importance here is that's the measure that we're looking at solvency on a short-term basis of sovereign debt. So what was the problem with Greece? The primary problem was it extended beyond its target. The maximum amount of debt or deficit, the deficit that a country in the Eurozone can have is 3% of its GDP. Greece was up to 12. So when we're looking at this, I'm just going to flip through back to, so if we look at net debt, the federal budget as a percent of GDP, which is the bottom line there for the US, we can see the US is in Greek territory. It's at 12% of its GDP deficit. So again, is this a sustainable recovery? In that sense, it's inflated. We're getting liquidity into the system, but the US government isn't doing a lot to encourage consumers to get in. It's going into a deficit position. That has ramifications further on because somebody's going to have to pick that up. If the economy is functioning, the government, its fiscal policy, puts money into the economy by doing this, by running a deficit. But if the economy starts going and they withdraw that, it'll slow the economy down. So there needs to be private capital coming in behind that. And we're not seeing that right now. So back to the four factors I promised you about. That's sort of the macroeconomic perspective. But what I like to do is condense it into, or distill it down to these four factors. So let's look at U.S. housing markets. One of the measures I like to look at is an index called the U.S. or the Case-Shiller Home Price Index. So this chart goes back to 1988 and says where are home prices based on a 10-city composite in the U.S. And the idea is to say without a recovery in home prices in the U.S., consumers won't spend the way they did before or the way they need to in order to reflate the economy. So what's happening to housing prices? This is just the year-over-year change. So let's look at down here. This is January 2009. Year-over-year, we were down almost 20% in the U.S. That is the cause of the financial crisis we had. So there's all kinds of things about the derivatives and the products that were, the financial products that were put into place. But had housing prices not dropped this precipitously, we probably wouldn't be anywhere close to the problem we're having today. Now, is it getting a little better? Absolutely. February, we saw a year-over-year increase of 1.4%. But we're still not recovered fully. In fact, this tells us what the U.S. household balance sheet looks like. This is what it used to be. So 60%, this is the owner's equity, used to be about 60%. It dropped down here to 33% at the height of the crisis. So what that means is, if you put your thought to it, that means that the U.S. consumer is looking at feeling wealthy. The wealth effect says, I've got a lot of value in my house, I can go out and spend. Housing prices drop and reduce by almost half the equity that a U.S. consumer has in his or her house, and all of a sudden, there's not a great impetus to want to spend. So what do we see here? Gradually increasing trend, but by no means a demonstrable way to say that this is unequivocal recovery. Now, if we looked at the next, so that's the housing market. U.S. housing markets need to recover. Second factor is U.S. consumer sentiment. So that's linked to the housing prices, but it's all about how the consumer feels. It's not just what they're feeling and they're seeing in their bank accounts, but how they feel. So what we're seeing is that the April value, or more importantly, look at this trend. We go back to January 2008, consumer sentiment is lagging. We're not getting a great increase. And until consumers feel confident, recovery doesn't happen. Another factor that influences consumers, or U.S. consumers, is the unemployment rate. And what I'd like to show here, this is my second economics geek slide. This is the unemployment rate that you're going to see normally, U3. So this has been restated since this slide of 2010. It's 9.7% here. It's now 9.9% in the U.S., despite jobs coming into the market. The U.S. created more jobs than it lost last month. So you're saying, well, how can unemployment go up? Well, partly is because of the measure. The second, and this is why I'm saying it's an economics geek slide, is U6. So this line here is a more broadly defined measure of unemployment. U3, which you read about in the papers, talks about those who are unemployed. U6 talks about those people who've stopped looking for jobs. Now, as far as I'm concerned, those people are unemployed. As far as what we're hearing reported, so that 9.9% unemployment in the U.S. doesn't include people who've stopped looking for jobs. We're really more close to 17% unemployment in the U.S. right now. Until that starts to recover, we don't see a full economic recovery. Look at this longer term. We can look at U6 even being somewhere in the 10% range and U3 being in the 4% range. That's where it's going to be. That's frictional unemployment. But still almost twice the level that we would expect in a normal circumstance. So this is just I'm going to go through this quickly. Canada's in much better shape.